Hi, good morning, everyone. Students, welcome to all of you for the AFM class. Students, majority of you are, as I know that, majority of you are using or going to attend an online class for the first time today. So during the class, you need to communicate with me over here. You can ask your question over here, and whenever I ask question from you people, you have to respond over here. This is the chat box in front of you. So, students, I just need to know, first of all, I just need to know whether you people can hear me. Now, respond, please. Whether you people can hear me. Just let me know. Yes, please. Okay, good. Right. For others who are unable to hear me, for them, something is displayed on the screen. Good morning. Okay, good, Sabrina. Welcome, welcome. Okay, now, so students, advanced financial management. Advanced financial management. Student, advanced financial management is the paper of ACCA, which has its roots from, it has its base from financial management F9 paper of level 2 of ACCA. Student, this paper, AFM, is much more challenging in aspect of, to just 1 minute please. Okay, can't hear. Okay, just 1 minute, student. This is the first day, that's why we have to settle down the issues the first day. Yes. Now, yes, so it has roots from F9 financial management. I was telling to you people, this exam paper, remember, exam paper is quite challenging. It is considered to be like that because of the lengthy scenario, too much information, and you know that students, these are the lengthy scenarios, and there is too much information in each scenario. Information in the form of data, and students, and hence there is issue of time pressure always. But if you see, it has better pass percentage than P7 paper. It has better pass percentage. AFM paper, it should be very much clear from the day first that AFM paper is based on 50% calculation and 50% marks are around 50% in every paper, 45 to 50% theoretical discussion of that calculation. Yes, analysis. The mistake which students do, the mistakes which students do is that they actually consider that they keep focusing only calculation part. They keep focusing only calculation. Yes. And they ignore theoretical discursive portion. They spend too much time over here during their preparation and in the exam as well, while they bear equal marks, around equal marks in the paper. If you pick any past paper, you will find it easily that 45 to 50% marks are for discursive parts. So this, but that discussion is based on calculation. It is also correct that you should be strong in the calculation and the concepts so that you can analyze it. But once you are expert in it, when you have good command over here, you have to work here. This is mandatory. If you want to pass your paper in the first attempt, you must have to prepare theoretical aspect of the syllabus as well. Now, next. So students, some more people are joining. It is possible to get a recorded lecture? No, not possible, dear. Yes. Recorded lectures are available only in the case, exceptions, when you miss the class due to urgency. Okay? They're only available. Yes. Now, next. So it is just like a class. When you go and attend a college, what do? You attend a college, a class in a classroom, and you want to recheck the lecture. What do you do then? Yes, it is similar thing. Okay? Now, dear, you should have discussed it with me before. Okay? You should have discussed it with me before. It's not right place to discuss. Right? Now. Now. So, students, next. AFM exam, AFM subject, the syllabus. We can classify the syllabus into three major sections, three main sections, AFM syllabus. One is, yes, advanced investment appraisal, major section. The other is risk management. And the third is mergers and acquisitions. And a small part of, I consider the same, that is reconstruction, reorganization and reconstruction. Reconstruction. So student, these are the three major sections of your syllabus. And in exam, they weight equal weight is there. Student, advanced investment appraisal is again we say it starts with the payback period method and Npv, IRR. You have studied already these things, ARR, but there are additional, that is discounted payback, duration as well, and MIRR. So additional techniques are there. And there are further aspects of, and there is another technique that is APV, adjusted present value. There are further aspects of discounted cash flows. Risk and uncertainty, capital rationing is there. And then weighted average cost of capital. So this is your investment appraisal. And then international investment appraisal. And the next is Black-Scholes model. Yes. So this is investment appraisal, students. And this is the major portion of your syllabus, a big portion of syllabus. And remember, students, a good command on this area will help you in this area as well, mergers and acquisition and reorganization. It is to some extent linked with that. It will help over there. Risk management is of major two types. That is currency risk management, when you involve in international transactions. So you face adverse risk of adverse movement of currency. Second is interest rate risk management. Interest rate risk management. So students, so in this case, so this is again one of the major proportion, and the latest past paper, latest attempt, which was tested in December, question 1, which is a 50-mark case study in December 19, that was on this area. That was on this area. So very important, very interesting, and very tricky as well, a bit. And now, merger and acquisition includes the valuation of the company. That when you acquire a company, how to put a value. When you sell a company, what are the different methods of valuation of a company? And other theoretical aspects of mergers and acquisition as well. Other theoretical aspects, theory topic as well are there. And students, reconstruction is again that you want to reconstruct a company, reconstruct, reorganize. Business is being drowned. It is facing losses. Now you want to reconstruct from different aspect. So we will be discussing over there calculation plus analysis area. And students, in addition to these three topics, there are some topics of ethics. There are some topics of corporate governance. There are some topics discussion on that is international financial institutions, just like IMF, World Bank, etc. Their roles, European Bank of England, like that, their roles. And students, so there is a topic theoretical that is on Islamic finance, that is part of your syllabus. And there may be more, some few small topics of the AFM theoretical discussion. So students, in exam, let me tell you, in exam, all three areas carry equal weightage. They can be tested with the equal chance. We know that exam contains question number 1, 50-mark case study. And this case study may be from one section. Usually it is the combination, means two sections are mixed. Either they may be testing some part from here and there, or here and there. They may be mixing, examiner. And section 2, that is question 2 and 3, that they are 25 marks. Yes. And they are more specific usually. And I have told you already, they're the balance of calculation followed by discussion usually. I hope it is clear. Students, how will we proceed? How will we proceed? Now, students, we will start with the investment appraisal today itself. This is the first topic to be done. Then we will be doing risk management. Then we will be shifting towards risk management area of your syllabus. Now, and then after that, we will be doing merger and acquisition at the end. We will be doing now. So students, let us proceed further with the investment appraisal. Any question so far? Anyone, any question, please? Feel free to ask. Anyone, any question? I'm waiting for your question. Yes, please. Yes, students. Any question, anyone? No. Okay. So students, what I will do, I will send in the coming week to you volume 1 of the notes. Volume 1 of the notes will be sent in the coming week, which will contain basically the investment appraisal full, which contains the full investment appraisal area, plus its practice questions. Practice questions. Volume 2 will contain the remaining syllabus that will be sent as well later on. So practice questions from the past paper, they are already part of these handouts. So it means that if you prepare these handouts well, plus some of the past papers, they will be sufficient for preparation of exam. Now, so let us start with it. Investment appraisal. Students, all the businesses, when they launch their project, when they start their businesses, they need to appraise first before making a huge capital investment. Just like they want to start a new factory, a new line of business, or they want to launch a new product. So they just want to appraise it first of all, whether it will be worthwhile to invest in such in such product or project or not. So student, investment appraisal techniques. So there are different techniques and methodologies. Yes, different techniques and methodologies that need to be considered. First of all is we can classify them into two types, categories. I have already listed with you people those techniques. So they are classified into two types. One is non-discounting techniques. The other are discounting techniques. So payback period method and ARR, accounting rate of return, which is also called ROCE, return on capital employed. They are non-discounting techniques. And discounting techniques, discounted payback, yes, that is NPV, IRR, duration, MIRR, APV, they are all discounting techniques. Now, we need to understand what is the meaning of discounting and non-discounting. We need to understand. Students, we will discuss it in a while. Let us come to the payback period. Payback period method. Payback is the time period in which initial investment of the project is returned. Payback is the time period in which initial investment of the project is recovered, will be recovered. Of course, every business has the first interest that we are going to make an investment. In how much time we will get our investment back? So payback period method is there. Let me just show you the notes as well. Then this is the tables which will be provided to you in the exams. Yes, here they are. So payback period method. Example is given over here. You see here. Now, so student, for example, we say that a project requires initial investment of 20 million, and project will yield cash flows of 5 million every year for 10 years period. So what is the payback? So payback of the project will be very easy. That is initial investment divided by annual cash flow, that is equal to 20 million divided by 5 million, equal to 4 years. So the project will be repaid. It will prepay its initial investment in the 4-year time. This is the payback period. Now, next. Next. So students, next is, so this is the case when there are constant cash flow. Some may be the case. Case 2. For example, a project has initial investment of 20 million and it will yield cash flow in this way: 6 million, 4 million, 7 million, 5 million, 6 million. So you see variation is in the cash flow. Now, how to calculate payback? When the cash flows are uneven, and practically cash flows are uneven of the projects, practically. This is the case most practically. Then another column of cumulative cash flow we will make. Cumulative cash flow column. So student, you see here, cumulative cash flow column. So here 200 negative, sorry, 20 negative, I mistakenly wrote 20 negative, 20 million negative. Then 6 million received, 14 million negative. Then 4 million recovered, 10 million negative. Then 7 million recovered, 3 million negative. It means that after 3 years, you see here, we need how much? 3 million. And year 5, we are getting 5 million. In year 4, we are getting 5 million. So year 4, part of year 4 will be consumed. Part of year 4 will be consumed. And then to recover this. So 3-year plus 3-year full plus this remaining cash flow divided by what is the total cash flow here? 5 million. So we can simply calculate it. It is 3.6 years. That is equal to payback period of the project. Payback period of the project. Now, student, is it clear to everyone? Any question, anyone? Yes, students. Is it clear? Please, you need to respond to me, please. You have to respond my question, please. Now, thank you. Thank you. Let us proceed further. Okay, page 1. Which page, Ibtisam? Let me know. Here or previous one? Page 1 is here. Here is the page 1. This one? Okay, that example. Okay, here it is. Students, if it happens, just like Mr. Ittasam, he took an initiative to talk to me to stay on the page. Sometimes it happens that I move on the next page and you have not noted down something. So do let me know. I will feel it pleasure to be back on the page so that you can note down. Now, thank you. So student, payback period method. It has its advantages and drawbacks. I will go to the notes and will have a quicker view. Okay, first of all, payback period method. Yes. Okay, ARR. Come to the ARR. Its advantage, disadvantages will come later on with the discounted payback. Discounted payback. Same topic actually they are. Now, accounting rate of return. Students, kindly note down 2-3 disadvantage over here. I just want to discuss that. It has a advantage payback, that it is cash flow based technique, not profit based. It is cash flow based technique because we are utilizing cash flows. Profits are subject to manipulation, not the cash flows. Second, it is screening device for investment appraisal, because a screening device means that if, for example, a company is going to obtain a loan for 5 years, so company have to return loan in 5 years. It means the project must have payback less than 5 years, so that company can pay off the loan. If the project has payback more than 5 years, then company cannot move forward to the project with the project, because loan is available for 5 years only, or investment is available for the fixed time. Drawback. Student, what are the drawbacks? So two major drawbacks. One is that it does not consider time value of money? Yes, it does not consider. You see here, we did the calculations over here. We did the calculations over here, and we are considering the cash flows just like they are same every year, but they have different value. The cash flow which are occurring in the third year, they do not have same value. The cash flow which are occurring today. Today's $1 has more worth than tomorrow's. So but it is not considering this fact. Second, it ignores the cash flows to be occurred after payback period. It ignores the cash flows to be occurred after payback period. Two projects, A and B, they have 3-year payback. Means they will return the investment 3 year. But from 4-year, 5-year, year 4, year 5, it is giving 10 million, 10 million. It is giving 20 million, 50 million. So payback is not helping us to decide. It is not talking about it. It is say both have 3-year cash flow. Anyone can be accepted. So it ignores the cash flow which occurred after payback period. It ignores simply. Now, next. Next. So students, the next method is accounting rate of return, ARR. It is profits based. It is the only technique which is profits based. So the formula is here. ARR is equal to average profit divided by average investment multiplied by 100. So students, let us go to the board. So ARR, accounting rate of return, is equal to estimated average profit. Because as why estimated? Because it is about the future. We are going to appraise a future investment divided by average investment cross 100. Cross 100. Now, how to calculate average profit? Average profit is equal to total profit of the project for all years divided by number of years. And how to calculate average investment is equal to initial investment plus scrap value divided by 2. Sometimes students, sometimes you may find it divided by initial investment instead of average investment. Remember, average investment is preferable by your examiner. That is preferable. Answer will be different in both ways. If you use only initial investment, answer will be different. But average investment is preferable by your examiner. Now, let us try to understand it by an example. For example, a project has following initial investment 1,000 and profits. I will say profits because it is profits based only technique. They are 200, 190, 180, 195. Scrap value of the project is machinery is, that is 90. Now, student, average annual profit we will calculate. Average annual profit we will calculate. Yes. So it is 191. This all sum divided by 4. Sum of all divided by 4. Yes. Sum of all divided by 4. 191. So average investment 1000 plus 90 divided by 2. That is 545. 545. So ARR 191 divided by 545 cross 100. So it is 35%. Student, the companies have target ARR. For example, and each company decide their own target ARR. A company has target ARR of 25%. So if project's ARR greater than target ARR, we say accept the project. Yes. We say accept the project. Now, next. Students, ARR has yes. All of you? Yes. Can you hear me, all of you? Okay. Now, good. Now, good. I just wanted to confirm because I felt like that you cannot hear me. I felt like that. Anyways. So, students, ARR has its own drawbacks and own advantages. So, advantage is quite advantage. It is simple to calculate and easy to be understood by business managers. But it has drawbacks, serious drawbacks. Drawback is this profits based, which are subject to manipulation, Students, profits can be manipulated by accounting conventions, increasing, decreasing provision, depreciation. They can easily be manipulated. And the next is, it again does not consider time value of money. No discounting. We just add a profit, calculate an average, and calculate the result. We consider all the profits have same, same value, and we just should not. And the third is, it is a relative term. Relative term. What is the meaning of percentage? 35% profit. Now, how much total profit? ARR is telling 35%. So it is silent. ARR is not telling us. It is relative. So two projects, for example, two projects, project A, project B, their ARR is 35% and 25%. Now, as per ARR, we should select this because higher ARR. But students, for example, profits are like that. Its profits are 20 million, its profits are 15 million. Now absolute term, quantification, this amount is more. But in the relative term, in the percentage term, it is less. So the person, if we focus only on the percentage, we will say, okay, we should accept it. So ARR is a relative term. Okay. So it is not telling about size of project. How big is the project? It is not telling anything. Is it clear, student? Is it clear? Yes, please. Do let me know. Is it clear? Good. Now, next. Next. So ARR is done. Now, students, I told you that discounting techniques. So, student, there is a concept of time value of money. That the value of today's $1, today's dollar has more value than tomorrow's. Why? Due to three reasons, due to following reasons. So this is called time value of money. Reason, what are the reasons and why it has more value? The reason is this. First of all, that is inflation. That due to inflation in the economy, currency will be devalued tomorrow. Second, opportunity for investment. Invest today. You receive today, invest today, and you may become it double tomorrow. But if you are getting tomorrow, that will be $1. So I repeat my words. You have two options. Receive $1 today or tomorrow. If you receive today, you can invest it and make it $2 tomorrow. But if you receive tomorrow, that will be $1 only. So today's money has more value. And the third is risk. Today it is sure you are getting it. Now, but tomorrow it is uncertain. Risk is there. Risk is there. Unknown risk is there. So time value of money exists because of these three factors. These three factors. So students, for the payback period and for ARR, we narrated a factor that they ignore time value of money. They ignore time value of money. So then they came the discounting techniques. So discounting techniques are those which actually consider time value of money. So we are moving towards discounted payback period method of investment appraisal. So students, payback we have discussed. Now discounted payback is extension of that. For example, a project has the following cash flows. So a project has the following cash flows: 3, 4, yes, and 5. Excuse me. 10 million, okay, make it 100 million. 100 million, 30 million, 35 million, 45 million, and 20 million and 60. Student, calculate its payback. Be quick. Simple payback, which we learned a few minutes ago. Be quick, calculate its payback and tell me the answer in the chat box. Be quick. Calculate its simple payback. Be quick, everyone. Okay, 2.77 is the answer. Majority are. Okay, 2 year, 9 months, it's okay as well. In the months as well. 2.77 years. Now, students, for example, cost of capital, rate of return is, or discount rate is 10%. 10% discount rate is 10%. So students, how to calculate? Now we will apply discount rate, discount factor. Yes, discount factor 10%. From the discount table, we will see 1.909, 0.826, 0.651, 0.683. Sorry, 726, 0.751, 0.683, 0.621. Discount factor. So present values we will calculate. 100 is the present value. And here in year 1, present value will be like that. Yes. 30 into 0.909. 27.27. 28.91. 33.795. Yes. It is 13.66. 37.26. Now, students, this is the present value of the cash flows. Now, cumulative cash flows column will make from it. So 100 negative, 27.7 received, 27.27, 72.73 negative. Now this received 28.91. So 43.82 negative. Now this received. So 10.0. Yes. So you see here 3 year complete and the part of year 4 plus 10 divided by 13.66. Yes. So what is the answer? So it is 3.73 years. You see here, this is the discounted payback of the same project. You calculated simple payback is here. So you see, the discounted payback is higher because you consider time value of money. Cash flows value are in real terms, but excluding the impact of time. So the drawback was, which was there in the non-discounting techniques, it has been removed. So discounted payback, we have a certain one thing over here, that discounted payback is always greater than simple payback of the project, of a project. Yes, we have a certain one thing. Now students, other drawbacks and advantages of the method are the same as that of payback period method. Other drawbacks and the advantages are the same. Only one drawback removed. Only one drawback. Still drawback that it ignores the cash flow after the payback period. The second drawback was that it is still there. It ignores the drawback that cash flows after. Still, I will write it here. Still there, the point is, it ignores the cash flows after payback period. It ignores that. Now, here comes the concept of duration. Here comes the concept of duration, which you have not studied in your previous study. Duration. Here comes the concept, which is P4 topic basically. Duration is the concept. It is an investment appraisal technique which caters both, which considers full life of the project as well as time value of money as well. As well as time value of money. It considers both one and second two. Students, duration. I will discuss its definition a bit later on, but first of all, we need to know how it is calculated. Then we can understand its definition, otherwise we cannot. For example, a project is, cash flows are as follows. For example, a project has the following cash flows: 1, 2, 3, and 4. Investment is 200 million and 60, 85, and 40, 30. Okay, I will just a bit modify more cash flows, a bit modification. Let us do it 90. These are the cash flows. Rate of return, discount factor is 10% again. Students, we will apply. So step 1, present value. Calculate, step 1, calculate present value of return phase. What is return phase? Return phase is basically, what is return phase? Return phase is where the phase after first positive cash flow. First positive cash flow occurring here, year 1. For example, if first positive cash flow is coming in year 2, then it would start over here. Return phase. The phase starts when first positive cash flow occurs. That is called return phase. So discount factor we will apply. I said the return phase. So here is return phase. 0.909, 0.826, 0.683. So we will calculate the present value. Yes, this is step number 1. So students, simply 90 cross 0.909. It is 81.81. 85 cross 0.826. 70.21. 40 cross 0.751. It is 30. 0.683. 20.5. Now, so total present value of all return phase. Now, 81.81 plus. So it is 202.52 total present value. Now students, you see here, we calculated present value. Now, step 2, divide each present value with total present value. Each present value means this divided by this divided by this. Yes. So we will get a fraction. So I will write number of year over here again, because number of year will have 1, 2, 3, and 4. Here, these are the years. Yes, these are the years. Now, so 81.81 divided by 202.52. It is 0.404. 70.21 divided by 202.52. Yes. 0.347. 30 divided by 202.52. Yes. 0.148. 20.5 divided by 202.52. 0.101. Now student, we have calculated the fraction. Now step 3. Multiply each fraction with relevant number of year. Now, what does it mean? This multiplied by this multiplied by this multiplied by this, and this multiplied by this. Relevant number of year. So it is 0.404 multiplication after. So 0.347 cross 2. 0.694. So 0.148 cross 3. 0.444. 0.101 cross 4. 0.404. Now, step number 4. Calculate the sum of all above. Yes, sum of all. $1.946. This is duration of the project. Students, note it down. I will re-explain the project process. I will re-explain the process. Once you have noted down, let me know in the chat box. Done. Then I'll proceed further. Good. Now, so students, just see here for a recall. First of all, calculate present values of return phase. Remember return phase only. Then calculate the fraction, present value of each year with the total present value. Okay. Be quick, please. Okay. Now, so I'll repeat. Present value of the return phase we will calculate by applying discount factor, each cash flows. Total present value you got of the return phase. Don't forget it. This is not NPV. This is present value of return phase. Don't do blunder over here by calculating NPV. Second is divide each present value with total present value. Yes. So we calculated a fraction here. Now multiply each fraction with the relevant number of year. And the sum of all will be duration. Now students, you see here, the definition of duration I am going to discuss with you people. Duration is basically, it is weighted average time to recover the cash flows of project, to recover the, present value of cash flows of the project, of a project. You see, we did weighted average time. So this is the weighted average time. Weighted average time. Utilizing all the cash flows, return phase. Students, remember how to interpret it. You see, what does it mean? Mr. Hamzah, what does it mean? Your question may be there. What does it mean? How to interpret it? How to interpret it? So remember, if duration of a project is less than half of life of a project, it means project's major cash flows are occurring in early years of project. Early years of, you see, we had a project with the life of 4 years. 4 years. So answer is 1.946. It is less than half. What is half of it? Half of it is 2 years. It is less than that. So majority of the cash flows are occurring in the early year. If you see, it is giving the same idea. You see here, it is verifiable over here. Majority of the cash flows are occurring in the early years. Or if duration of project, duration of a project is greater than half of the life of project. What does it mean? Project's major cash flows are occurring in later years of project. Means if answer is 2 point something, 2.8 duration, 2.7, more than 2 in this case we did, then we say it is yes. Student, is it clear? Okay, now next. Okay, now next. So students, duration is done. So the topic of duration is done. Next is net present value, NPV. Net present value of investment appraisal, method of investment appraisal. NPV, we know how it is calculated. NPV, basically, this method of investment appraisal, it tells the exact impact of a project on shareholders' wealth. I will explain in a while. On shareholders' wealth. NPV tells that whether due to a project, shareholders' wealth is going to increase or decrease, or it remain the same. So NPV is equal to present value of cash inflows minus present value of cash outflows. Yes. Cash inflows and outflows. Next. So students, for example, a project has, I will explain the definition, 0, 1, 2, 3, and 4. Just 1 minute, please. Just 1 minute, please. Okay, now a project has cash flows as follows: 200, 90, 85, 40, and 30. And for example, discount rate is R is equal to 10%. So discount factor 10%, 1.909, 0.826, 0.751, 0.683. So we will multiply it: 200, 81.81, 70.21, 30, and 20.5. So NPV, net present value. Matthew, you should have asked this question over there. You are asking it from WhatsApp. I think you cannot message over there. So the question is that what happens if the cash flows are uneven? I will answer this question. Matthew, okay? In a while. Let me finish the example. Okay? I will answer your question. Don't you worry. You are asking it about, you should ask the question over here. Over here. And your question is about duration. Your question is about duration. Okay, I will solve one example. Let me finish this NPV example. Then I will solve that. And you should send your question over here as well, so that everyone can see the question. Now, so NPV is 3 million positive, 3. So NPV, for example, you see here, if we add up all these, it is 203 minus 200, it is 3 million. Answer. This 3 million means that the company invested this and got net return this. So the net of it is 3 million. 3 million. So the company invested this and got more. So the shareholders' wealth has been increased by this. So NPV is the impact of a project on the shareholder wealth. Exact impact. So shareholders' wealth has been increased by 3 million. For example, I will change my example. For example, present value of cash inflows is cash inflows. That is 203. But outflows are more, 210. So negative 7. It means shareholders' wealth has reduced by 7 million due to project. So NPV. Yes. Yes, Matthew, please share your question here. Be quick, so that I can answer that. Otherwise, people will not be able to know what is the question. Your question is wonderful. It is good question. Yeah. So question is about duration. Yes. So I'm just going to answer. Just give me 1 minute, please. Just 1 minute, please. Now, Students, for example, they say this. Have you seen the question, all of you? I'm sure all of you have seen the question. Yes. So students, just see here. If the cash flows are like that, if the cash flows are like that, just see here. Just see here. Just see here. The issue is with the return phase. What is return phase actually? I will try to explain first that. For example, a project involved investment of 400 million here, 200 million here, and 100 million here. And positive cash flow occur from here, 700 million, 800 million, 300 million, 200. So return phase is starting from here. One example. Second example. Second example. Year 0, 1, 2, 3, 4, 5. Investment is 1000 and first positive cash flow is 200. 350 positive and here negative 200. 100. Again I say negative 50. Make it 700, positive 700. Now return phase is starting from here. Although this figure will be negative here, but when they will be summed up, it will be adjusted against that. It is positive figure, negative, positive, negative. Net will be there. How many of you are unable to see that? What Kamlesh is saying. So it means, Kamlesh, problem is at your part, not here. Okay. So you got the answer. Matthew, you got the answer. No, not after first cash flow. Pause. It starts with the first positive cash flow, not after. Matthew, the answer is that the return phase starts with the first positive cash flow, not after that. Okay, now. Okay, now. Thank you for a good question. Now, so NPV method of investment appraisal, it is done. Now, so student, the next method of NPV, net present value method of investment appraisal. Its advantages and drawbacks. Its advantages and drawbacks. Advantages. First of all, student, it is cash flow based. Yes. Second is it considers time value of money. Third, it is absolute measure. And tells the exact impact of a project on shareholders' wealth. On shareholders' wealth, exact impact. copy the example given, which Matthew asked. No, here it is, this one, dear. Kamlesh, I'm asking you, this one? You can note down now so that I can proceed with the peace of mind. Okay, note it down, be quick. You can note down. Okay, right, next. So students, next is drawback. So absolute measure, it is telling what exact impact, just like we discussed over here, that NP will decrease, wealth will increase by 3 million. Positive. Will decrease by that. That's why we say that when NPV is positive, we have to accept the project. We can accept the project because wealth is increasing. And when NPV is negative, we say, if it is negative NPV projects, we say reject the project because wealth will decrease. Now, next. Next. I'm sorry. So next is drawback. Students, only one drawback. It is difficult for business manager to understand this concept. Know the drawback. Next. So next method of investment appraisal is IRR, internal rate of return. Internal rate of return, IRR. So just 1 minute, I will start it. Just 1 minute, please. So IRR, internal rate of return. Internal rate of return is basically, it is effective annual return of project, annual percentage return. Yes, percentage return project, considering time value of money. effective return. It is the yield from the project. What project is giving us effectively. And students, for example, how to calculate? Just see here. A project is there, 2, 3, and 4. Initial investment is 250, 60 million, 80 million, and 95 million, and 110 million. 110 million. Now, so for example, cost of capital is, our discount rate is 10%. So discount factor 1.909.826. So just I'm going to change some figure, this one only. For example, 120, 0.751.683. So we will calculate NPV at 10%. NPV at 10%. So mean present value, first of all, we will calculate 250 negative, present value, yes. So 60 cross 0.909. 54.54. 80 cross 0.826. 66. 120 cross 0.751. 90 rounded off. I make it 55 for our ease. Now 110 cross 0.683. It is 75. So NPV at 10%, it is, we can calculate the net of all. So it is 36 positive. Now students, we have to calculate another NPV. NPV at, I say, for example, 15%. 15%. So we have to calculate, and we have to apply discount factor at 15%. Yes. So discount factors are given. It will be provided to you in the exam formula sheet over here. Just like that, 15%. Yes, discount factor. So yes, simply we have to copy this over there. Discount factors 1 for year 1 and 0.870, 756 and 0.658 and 0.572. So we will multiply these discount factors with these cash flows, with the relevant cash flows. Yes, cash flows similarly. So 250 negative, and then 60 cross 0.870, 52. 80 cross 0.756, 61. 120 cross 0.658, 79. And 110 cross 0.572, it is 63. So NPV we can calculate. NPV at 15%. Here it is -5. Oh, sorry, +5. +5. NPV is again positive at it. Now, student, IRR, how it is calculated? The formula I write in my own words is equal to low rate of return plus NPV at low rate divided by NPV at low rate minus NPV at higher rate into higher rate minus low rate. Now you see here, low rate is 10% here. We used 10%. NPV at low rate 36. NPV at low rate again 36 minus NPV at higher rate 5 into higher rate 15 minus 10. So student, is it clear to everyone? Is that clear to everyone? Yes, please. Tell me. Is it clear to everyone so far? Now, tell me the answer. Solve it and tell me the answer. What is the answer? What is IRR? Tell me what is IRR? 15.8. Okay, 15.8%, 81%, right? So IRR, student, rule is if IRR of the project is greater than cost of capital, we say accept the project. Otherwise, reject the project. If it is less than cost of capital, we say reject the project. Now, so students, let me explain one thing over here. Why we say it should accept? For example, here IRR is 15.8% and cost of capital is, this is IRR, and cost of capital is 10%. It means that project is generating 5% excess return than its cost. This is the cost of funds invested. This is the cost which we have to pay. Cost of funds to the financiers. So project is generating 15.8%. So after paying to the financiers, still 5.8% is with us. 5.8% is with us. So the beneficial for us that we are earning more than we have to pay. That's why we should accept. If IRR is less than the project, that's why I say it is actually percentage return of the project. Project is yielding this to us. That's why we should accept the project. Students, in other words, if we say that the definition of IRR, the old-fashioned definition which you find in the books, the IRR definition is that it is the rate at which a project's NPV becomes zero. Means, what is the zero NPV meaning? Means that inflow, present value of inflow minus outflow, that is equal to zero. Means inflows are equal to outflow, present value. It means that you have deducted the return from it. Return. Then it is equal to outflow, simple. So this is return. If you deduct it, NP will become zero. Excess return if you return. Excess return if you deduct, then NPV becomes zero. NPV becomes zero. I hope it is clear to everyone. I hope it is clear to everyone. Now, so students, let us, okay, there is a question, just, okay, right. Let us try to learn IRR from graphical representation. This representation is not given in the notes or book, just to make it more clear. This is NPV, this is discount rates. So NPV at 10%, sorry, I have written inversely. This is discount rate and this is NPV, sorry. 10%, we used 10% and we used 15%. At 10%, NPV was how much? NPV was 36 and 5. 36 and 5. For example, 10, 20, 30 and 40. 36, I say here it was. And here it was 5. So just see here what we will do here, and it will touch it here, which is actually you calculated. That is 15.8%. If you draw it properly, yes, so it will touch it here. Yes, 15.8%. NPV is zero here. IRR, 2 points. Now, next. Next. So students, IRR has its advantages and drawbacks. Advantages of IRR. First of all, cash flow based, considers time value of money. Yes. But drawbacks are more challenging. Drawbacks are more challenging. One drawback is that it is a relative term. We know it is relative term. It does not in percentage. It is relative term. Second drawback is that students, I need attention of everybody. This is a very important thing I'm going to discuss. For non-conventional cash flows, multiple IRRs are generated. multiple IRRs. What does it mean? What does it mean? Multiple IRRs are generated. What does it mean? Let us talk about it. Students, first of all, non-conventional. What is conventional? Conventional cash flows are those cash flows, conventional cash flows, which is initially outflow and then are inflow. This is conventional. And what is non-conventional? Inverse of it? Non-conventional. What is it? Initially outflow, then inflow, then outflow, then inflow, then outflow, and then inflow. In this case, when we calculate IRR through spreadsheet, not manually. Spreadsheet give more than one IRR. Spreadsheet give answer, for example, IRR 15%, 43%, 2 IRR. For example, and it happens practically. If cost of capital is 18%, now tell me whether we should accept the project or not. If we consider this IRR, we should not accept project. If we consider this IRR, we should accept. This is problem. This is the problem with the IRR. That through spreadsheet, when we apply it to the non-conventional cash flows, now, next. So students, I hope it is clear. I hope it is clear. If it is not clear, you can ask me the question. I am proceeding to the next point. The next, another tricky point. IRR assumes that cash flows generated annually by project are reinvested at a rate equal to IRR, which may not be possible if IRR of project is too high. Note it down, then I'll explain. Note it down, then I'll explain. Now, students, for example, we said above, have you noted it down? Should I explain it? Now, next. Okay. So just see here. Just see here. Students, the cash flow generated, these are the cash flow generated of the project. These are the excess cash flow. IRR assumes that these can be reinvested by the company somewhere else at the same rate of IRR. This rate. And you know that sometimes it happens, one project is giving abnormal return, abnormal high percentage return. It happens. Some products are very successful and some may not be successful. And we may not find all the projects with the same return. So they say that you are having these excess cash flows. You are having these excess cash flow and you can invest them at 16%. Or if IRR is 25%, you can invest these at 25%. And practically, it is not possible. If you are earning high cash flow, high return from one project, you may not find to invest that excess cash somewhere else at the same return rate. This is the wrong assumption of IRR in that case. Because all the projects, so it is not easily possible to find all the projects with the higher return. Is it clear? Is it clear? Now, next. So students, next point. Next point. So let us compare NPV and IRR method comparison. This is comparison important. Students, NPV, for example, a project A and project B. Two projects are there. So project A and project B. Its NPV is 300 million. Its NPV is 400 million. Its IRR is 32%. Its IRR is 25%. Now, as per NPV, if we see, we should select this. As per IRR, we should select this A, because NPV is dictating this and IRR is dictating this. Now, which one should be selected? Which project? So, on which method that will be preferred? Which method will be preferred? On which basis we have to make a decision? That is NPV. That is NPV is preferred to make decision. Why? Two reasons. First of all, NPV tells the exact impact on shareholders' wealth. Yes, it tells the exact impact and is absolute term. Now, next. Second, students, NPV method assumes, this is very important, not discussed before, that cash flows of the project are reinvested at a rate equal to cost of capital, which is more realistic, than IRR. which assumes cash flows are reinvested at IRR at a rate equal to IRR. So reinvestment I have told you about. The IRR assumption is wrong. So NPV assumes that it is equal to cost of capital, which is a bit balanced assumption. That minimum we will recover our cost. That's it. Student, all of you are clear about these points. Now, my question from you, any question, anyone, please. Is it clear to you people? Is it clear? Good. Now, next. So that's why NPV is preferred. That's why NPV is preferred. Now, students, now comes the next method of investment appraisal. That is again a new method for you. That is modified internal rate of return. MIRR. Students, this MIRR came to actually to remove drawbacks of IRR. Which drawback? Two drawbacks. One is that of multiple IRR, case 2, in case of non-conventional cash flow, and second is reinvestment assumption, which is wrong. We say that is inappropriate. IRR assumes cash flows are reinvested at IRR. So MIRR removed these both assumptions. These two flaws. Sorry. It removed. Students, do you need a break? Let me know. Do you need a short break? Frankly, let me know, because sometimes students complain, sir, we need break, and you didn't give any break. Let me know, please. Frankly. Great. Great. Now I'll proceed. Okay. So MIRR, modified internal rate of return. It has two formulas which are relevant to us. The first formula is here. That is terminal value and next is initial investment nth root minus 1. Nth root minus 1. Now, let me, yes. Yes. So present value of investment. Yes, this is the present value of initial investment minus 1. So nth is equal to number of years, life of the project. N is equal to life of project. Life of project. N is equal to. Now, what is terminal value? We will learn it. We will learn it how to calculate it. Just see here. I will write an example and then you will get to know. Just see here. A project is here. Yes. 1, 2, 3, 4 year life. So initial investment is 100 million and 30, 35, 20, and for example, it is 20 again. Discount factor is 10%. Cash flows of project, just see here, can be reinvested at, 11%. At 11% reinvested. You see here, reinvestment assumption. We are going to incorporate that. If question does not tell us this, then we can assume that cash flows are reinvested at cost of capital. We can assume. We can write assumption over there. So students, just see here. I'm going to solve it. Cash flow in year 1, 30. Invested for how many years? 3 years at 11%. So 30 into 1.11 raised to power 3. Invested. In 3 years it will grow. Now, second, it will be invested for 2 years till the end of project. 1.11 raised to power 2. And it will be invested for 1 year. It will be invested for 1 year. 20 into 1.11 raised to power 1. 1.1. Now tell me the answer of it. The first one. What is here? Tell me. 30 into 1.11. Yes. Raised to power 3. Be quick and tell me the answer. 41.028. Okay. Now here 35 into 1.11 raised to power 2. What is the answer here? 43.12. And here the last one, 20 into 1.11. 22.2. Now year 4 cash flow will be there. Just see here. The sum of all these 4. Sorry. The sum of all these 4. Tell me the sum. Sum of all these 4. Add all these 4 amounts. $106.32. 106 point. This is called terminal value. This is called terminal value. This is called terminal value. Now, I hope it is clear how to calculate terminal value. Now, simple present value, MIRR we can calculate. Now, nth root, nth root, not multiplication. It is 1 by 4 basically. 4. 106.32. Present value, it is already in here. 100 minus 1. Please solve it and tell me the answer of MIRR. Be quick. Solve it. Student, this calculation is wrong. This calculation is wrong. This sum is not a. We have to add 4 items. 1, 2, 3, 4. This calculation is wrong. Actually, my cell phone, the calculator was there. It is getting updated suddenly. So I'm unable to use that now. Please tell me this answer is not correct. It is not 106. It is not 106. Yes, it is 126. Yes. 0.348. Okay, 32. 126.3. 126. Now calculate. Now calculate the answer. Now calculate the answer. Okay, no issue, no issue, no issue, no issue. Sometimes it happens. No issue. Other people should also do calculation to be alert. No, this is not the answer. No, 6.02%. Yes, this is the answer. 6.02%. Exactly. In percentage, 6.02%. This is the MIRR. Yeah. Modified internal rate of return. Now, so students, let us proceed. Let us proceed further. So MIRR, yes, the same concept is there. If MIRR is greater than cost of capital, accept the project. If it is less than cost of capital, reject the project. Now, so students, next, there is another formula for MIRR. That is part of your notes. I have included that. Here it is. An example I have included that. Here is the formula in front of you. Yes. You need to memorize the both where it is present value of return phase. Return phase we have discussed. The present value of investment phase into 1 plus R. R is the cost of capital. R is the cost of capital. So in minus 1. So for example, a project has the following cash flows. Yes. A project has the following cash flows in front of you. Yes. So first of all, we need to calculate their present values. So present value. Yeah. So NPV they calculated basically. Now, next. MIRR, basically it should be present values. If we add up all these, If we add up all these, it is 1159. This 1159 present values. And the sum of these both is, yes, 945. We need not to calculate NPV. It should be present value only of return phase and the both. Into 1 plus 0.1 minus 1. So answer is 13 point raised to power 1 over 6. N is number of years, 6. 13.8%. 13.8%. Student, this formula can be used, remember, only when cost of capital is equal to rate of reinvestment. Remember, this formula can be used only when, if rate of investment, I repeat my words, I will write again. This can be used when rate of reinvestment is equal to cost of capital. If that is different, if they are different, then the first formula will be used. You can note down, please. Note down this formula on your copies and note down this thing. It can be used only. And after noting it down, tell me done so that I can proceed. Yes, we can use, Hadira, we can use the first formula when both rates are same. We can use that. Exactly. No. So you see here, why use MIRR? MIRR decision is in line with NPV. So there is lesser chance of conflict. Other is yes. No. Other reinvestment rate is good, and single answer does not produce multiple IRR. Easier to calculate. Problems of MIRR. It is not industry preferred method. Industry does not know. Manager do not understand it. Again, it is a relative percentage. It does not consider size and exact impact. Percentage answer it is. Now, so students, the next topic which we are going to study that is relevant to all of these topics which we have covered so far. Now, students, we have been using these net cash flows here, and in the NPV, IRR, MIRR, everywhere we have been using the net cash flows. But practically and in exam, we have to calculate these net cash flows. They are not provided in this way. We need to find and we need to calculate. We need to calculate net cash flows. So what is the way to calculate that? And what are the different factors affecting that? Students, remember, first of all, relevant cash flows are included. relevant cash flows are included. Now, what is the meaning of relevant cash flow? Relevant cash flows are those cash flows which are, although it is topic of F2, but those cash flows which are a direct consequence of investment decision. Which are future cash flows. Which are future cash flows. And which are incremental cash flows. Three things which are interrelated. Direct consequence of investment decision, which are future cash flows, and which are incremental cash flows. So let me give you some example to explain it. Students, feasibility study, we did a feasibility study of a project and we spent 2 million. That whether we should undertake the project or not. Now, whether it is relevant cash flow, not relevant, because it is not future cash flow, not a direct consequence of investment decision. Means that we make decision or not, it has we make investment or not. We make investment or not, this cost has been incurred already. Company is having a factory already, and for it is paying rent on that already. Launching a new project which will be managed in the same factory. So factory rent will not be charged to the project because it is not incremental. It is already being paid. Already being paid. So I have included a full page over it. Relevant and irrelevant. So, and of course it is from F2 paper of your ACCA. So I would suggest you should read yourself, sunk cost, committed cost, and if you face any problem, you can ask me. So about it. Now, students, this is the NPV pro forma or cash flow, net cash flow pro forma. These are the net cash flows which are used to calculate IRR, MIRR, NPV, payback, whatever it is, duration. So how they are calculated? This is the pro forma. Sales, incremental variable cost, incremental fixed cost, and other adjustments are there. Now NPV pro forma has multiple. This discounted cash flow has multiple adjustments. The first adjustment is that of inflation. So adjustments to net cash flows. Adjustments to net cash flows of project. So there are main 4 adjustments. One is adjustment of taxation, inflation, working capital, and the 4th is risk and uncertainty. Adjustment of risk, incorporating risk and uncertainty to the project. So 4 adjustments are there. One by one we will discuss all. One by one we will discuss all. Now, So students, first of all, adjustment of inflation and cash flow or NPV performer. It's better to use NP performer, adjustments, NP performer. Students, inflation impact are two aspects. One is cash flows and the other is cost of capital. Cash flows and cost of capital. Before discussing, inflation is of two types. One is general inflation and the other is specific inflation. General inflation is basically consumer price index, overall average inflation in the economy. Specific inflation is, for example, we say rice price increased by 10%. Furniture price increased by 15%. So this is specific. This is inflation of specific item. That is generic average. General inflation is generic, on average inflation in the economy. That is called general inflation. Now, come to the cash flows and cost of capital. Cash flows and cost of capital. Students, cash flows are of two types. Real cash flows and nominal or money cash flows. Real cash flows are those cash flows without impact of inflation. Nominal cash flows with impact of inflation. With impact, which includes the inflation. They're called money cash flow and nominal cash flow. Now, they are inflated. Basically, they are inflated cash flows. They are also called cash flows in current terms because the future inflation is not incorporated. Yes. And students, cost of capital. Again, it is of two types. The real cost of capital and money or nominal cost of capital. It is without inflation. It is with inflation. Now there is a Fisher's formula. Fisher's formula. That is 1 plus M is equal to 1 plus R into 1 plus I. Where M is equal to money cost of capital, R is equal to real cost of capital, and I is equal to general inflation. General inflation, remember. Yes. For example, real cost of capital is 7%. Inflation is 5%. So what is the money cost of capital? 1 plus M is equal to 1.07, 1.05. We can easily solve it and calculate. Yes. Yes. So M is equal to 12.35% money cost of capital. And we can calculate inverse as well. If money is given, we can calculate real with the general inflation as well. Now, student, why we are discussing it? The problem is actually approaches to calculate NPV. Two approaches. One is money approach or nominal approach. The other is real approach. To calculate NPV. In money approach or money method, all cash flows are inflated with their specific inflations. If sales is inflated by inflation rate is given 4%, for variable cost it is 5%, or whatever it is, they have to be inflated for each year with the same. And then discount money cost cash flows at the rate of money cost of capital to calculate NPV. Money method. So real approach. So here real cash flows are discounted at real cost of capital. Simple. Real cost of capital. If question is silent, usually we use nominal method. And usually question is silent. Usually we use money method, which is the most preferred method to calculate NPV. Now, next. So this was the adjustment of inflation. Now adjustment of taxation. Okay, here it is. Be quick, please. Okay. Thank you. Now, next. So student, next is adjustment of taxation. Taxation adjustment on NPV performer. Again, two aspects. One is cost of capital. The other is cash flows. Other is cash flows. So always use post-tax cost of capital for discounting purpose. Unless stated otherwise in sorry, in question. If question specifically says ignore taxation, then we can use pre-tax. So now, for example, pre-tax cost of capital is given 10% and tax rate is 30%. So what is post-tax cost of capital? Pre-tax cost of capital into 1 minus T. This is the formula. 1 minus tax rate. So pre-tax 10%, 1 minus 0.3. So 7% post-tax cost of capital. This is the answer. Now, next. Next. Yes, here it is. Cash flows. On the cash flows, student, this taxation respect is very important and it usually disturbs student in the exam. It usually disturbs the student in the exam. Let me tell you. Please focus. Now, two impact on the cash flow. One is tax payment on taxable cash flows. And second, tax saving on capital allowance. Tax saving on capital allowance. Two impacts. Now, tax payment on taxable cash flows. Students, we know that sales minus variable cost minus fixed cost. And then this is net taxable cash flow. Now tax has to be paid. Now I will write over here that tax has to be paid in arrears or in same year. As told in scenario. If scenario is silent, you can pay in the same year. Right assumption? Right assumption there. I assume that if scenario is silent, usually which is not. If scenario is silent, pay in any year, in any way. You can pay in arrear even. But right assumption that I assume that it is to be paid in the same year or in the arrears. Now, let me show you about it. One example. For example, this is the project 0, 0, 1, 2, 3. Taxable cash flow, sales minus costs. Let me write everything. Sales minus cost. All the costs. 100, 120 sales, 150. Cost is 70, 80, 100. Okay, 30, 40, and 50. Taxable cash flows. For example, tax payable 30% in arrears. Same year is very easy. Now for year 1, 30% will be here. 30% in 9. For year 2, it will be here. 12. For it, in year 4, we will add 15. This is how it has to be calculated. Taxation. Student, is it clear? Is that clear? Arrears. Same year is very easy. Is it clear? Now, next. Previous page, okay, here it is. This one. Okay. Okay, now, next. So now impact on now tax saving on capital allowance. I will discuss here below. Tax saving on capital allowance. The trickiest part of all. But it can be done in 2 ways. There are 2 ways to do. Both are correct. You can use any one. One, calculate capital allowance for each year. Second, multiply capital allowance with tax rate to a certain tax saving, and then add the tax saving to post tax cash flows in NPV performer. Next, I will calculate it. Just see here. For example, a machinery initial investment is 200,000, 200,000 or 200 million. Capital allowances 25% reducing balance basis. And tax rate is 30%. Now we have to calculate. For example, scrap value is 0, equal to 0. Okay, bit more complex. Scrap value is 10. Now, and life of project is 4 year. Just see here, 0, 1, 2, 3, and 4. And tax is in arrears. Tax is in arrears. Maximum complexity I want to add. So 200 is the investment. So capital allowance in the first year. So this is the carrying value. This is the carrying value. Capital allowance, that is 30%. 60 capital allowance. And here carrying value is how much? 140 remaining. So 42. And here carrying value is 98. So then you see here, this deducted this deducted this, then this, 98. So next is 98 cross 0.3, 29. Yes. So what is the carrying value? 69. And in the last year, how to do? 69 whole minus scrap value. Carrying value minus last year value minus 10. The whole rest will be charged as capital allowance. Here is the capital allowance. Sorry. Just 1 minute. I think I have done a mistake. Actually, I have applied capital allowance at 30%. Yes. Okay, we can change rate. 30% and it is 25%. 30%. Okay. Now it's okay. 30%. So now tax saving 25% in arrears. In arrears. I will re-explain it. Don't you worry. Okay. So 25% of it, 15 tax saving. 25% of it, yes, 10.5. 20 in area 29 cross 25, 7.25. And for year 4 it will go in year 5. We have to add 59 into, so it is around again 15, just rounding off. So this will be added to the post tax cash flows which calculated above. Here it will be added, tax saving on capital allowance. Here it will be added, post tax. This is the one way I told you. Note it down, I will re-explain it. Note it down, I will re-explain it. In the fourth year. Yes. I will let you know. I will explain it. Don't you worry. I will explain it, Amina. I will explain it. Okay? Just note down, then I'll explain. Okay, let's see here. I'm going to explain your question as well. Reducing balance basis, we have calculate the carrying value every year, 30% of it, capital allowance. This is clear. The question is here, why we have not calculated 30%? Because in the project has 4-year life. The whole carrying amount will be scrapped. That will be lost. We will be getting only 10. It was 69. We had to calculate 30%. But you know, after year 4, there is no project life. So 69, the carrying value, 10 we will get as scrap value by selling that. The difference is the loss. This is called balancing allowance. This is called balancing allowance. Okay, yeah. That has to be charged over here fully. Is it clear to everyone? Any confusion, any question, feel free to ask. Yes, please. I'm waiting for your any question, anyone. Okay, good. Next. Next. Student, this is the one way to add capital. There is another way. I told you 2 ways. What is the other way? Yes. Students, deduct capital allowance from pre-tax profits. Pre-tax profits. Then pay tax on the resultant amount. And then add back capital allowance to the post-tax profits. Add back. So this is the second way to incorporate. I will solve an example over it as well. Note it down, then I will solve an example over it as well. Should I proceed further? I think you have noted it down. Now, next. So student, you see here, you have calculated capital allowances here. I'm going to use the same example. You have calculated capital allowances here. The first step will be the same. Yes. 30% capital allowances. You have calculated. These are the capital allowances. The first step is the same. Now, for example, let me take the above figures here, these figures, which I used. And I will copy it below. Yes. Yes, here below. Here 0, 1, 2, 3, and 4. Now, so student, just see here. Sales 100, 120, 150. Now, costs 70, 80, and 100. Now, capital allowance has to be deducted here. The same capital allowance has to be deducted here. Here, 60. Deducted 60, 42. Yes. 29. And 52. 59. Sorry. And 59. Yes. It has to be deducted here. Now, net profit, taxable profit, will come here. Okay, it is, for example, it is, by chance this amount or less, okay, increase this amount, just because in exam it will not be like that. Okay, just to 220 and 180, make it 180. So for example, it is net 270 and yes, next is 220 minus 80 minus 42, 98. 180 and put it here, for example, 100 and here 30. 180 minus 100 minus 29, 51. And here it is 100 minus 30 minus 59, 11. Now tax has to be paid over there. 25% in arrears. Tax has to be paid in arrears. For it, tax will be here. You see here, 270 cross 0.25, 67.5. Yes. And tax has to be paid over here. You can calculate yourself. And for year 4, it will be in year 5. And then net profit after tax. Net profit after tax. You will get it. And now, student, you will add back capital allowance. If you deduct it, you will add back 60, 42, 29, and 59. Now, student, actually what happened? When you deducted it, your taxable profit reduced. And because of that, you have to pay less tax. Now you are adding back. So less tax means tax saving automatically adjusted. First you deduct it from the pre-tax profits. then taxable profit got reduced. So you have to pay less tax. Now net and you add back that, so the purpose is served. Tax saving is and remaining adjustment are the same. So the purpose is served. Is it clear to everyone that how to adjust tax saving in another way on capital allowance? The remaining will be the same calculation. Both methods are equally valid in exam. Equally valid. Both methods are. You can use any one of these. Any question, anyone, please let me know. Because some people responded, other people are silent. If it is not clear, do feel free to ask, please. Now, so students, that we have done more than the target for today, right? So in the next class, when we will meet next week, we will be doing adjustment of working capital. And at risk and uncertainty. This is the next class target. And some past exam questions as well. This is the target for next class. Plus, before that, I have to discuss with you the concept of annuity plus perpetuity. Annuity and perpetuity. Although it is from the F2, but still, I will try to find if I can arrange some video over it, because this is basic concept. I don't want to waste time over it, so that you can just watch annuity perpetuity at your ease. Okay, so I will try to do that, so that we may not waste time on this such basic thing, which should have been learned in F9 and F2. So students, kindly pay your dues in the coming week, and you can get the banking details from me to pay fee at this WhatsApp. You can WhatsApp me. Okay, I will share with you the banking details of mine where you can pay your fee, so that I can forward you volume 1. So try to pay it by 15th of this month, so that I can send you the volume 1 on the 15th. Volume 1, which will contain the whole section A, investment appraisal. Okay, a big section. So that's it for today. See you on the next Sunday. Yes. See you next Sunday. Goodbye. 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 Welcome. Welcome. Goodbye.